Buffett is worth over $100 billion. His business partner, Charlie Munger, was worth $2 billion when he died. They invested together for decades, used the same strategies, had access to the same opportunities. So, why is Buffett 50 times richer? The answer isn't intelligence, skill, or luck. It's something nobody talks about. Buffett started investing at age 10. Munger started at 30. Those 20 years of compound interest created a $98 billion difference. This is the psychology of money, where tiny behavioral differences create massive wealth differences. Morgan Housel's The Psychology of Money has sold over 7 million copies because it reveals an uncomfortable truth. Doing well with money has little to do with how smart you are and everything to do with how you behave. You can be a genius and go broke. You can be average intelligence and become wealthy. The difference is psychology, not IQ. This book destroys the myth that finance is about math and spreadsheets. It's about behavior, emotions, and the stories we tell ourselves. A person who earns $50,000 and saves $10,000 is doing better financially than someone earning $200,000 who saves nothing. The higher earner looks richer. The modest earner is actually building wealth. Psychology beats income every time. Housel, a former columnist at the Wall Street Journal, studied thousands of investors and discovered that financial success isn't about what you know. It's about how you behave when markets crash, when your neighbor buys a bigger house, when everyone else is getting rich from something you don't understand. Your behavior in these moments determines your financial destiny more than any investment strategy ever will. Over the next 30 minutes, you're getting 8 timeless psychological lessons about wealth, greed, and happiness from one of the most original finance books ever written. These aren't tips about which stocks to buy or how to budget. These are fundamental truths about human behavior and money that change how you think about wealth forever. Ready to understand why smart people do stupid things with money? Let's go. Chapter 1. No one's crazy. Your money story shapes everything. Housel's first lesson destroys the judgment we all have about others' financial decisions. No one's crazy with money. They're just operating from different experiences that shaped different worldviews. The person who refuses to invest in stocks isn't stupid. They might have watched their parents lose everything in 2008. Your financial behaviors make perfect sense given your unique experiences with money. He shares a powerful example. If you were born in 1970, the stock market rose dramatically during your teens and 20s. Your experience taught you stocks always go up. Take risk. Get rewarded. If you were born in 1950, your teen and young adult years included terrible markets. Your experience taught you stocks are dangerous. Safety matters more than growth. Neither group is wrong. They're both right based on their formative experiences. But they'll make completely different decisions for completely reasonable reasons based on completely different lessons from completely different times. The person from 1970 thinks the person from 1950 is too conservative. The person from 1950 thinks the person from 1970 is recklessly aggressive. Both are prisoners of their own history. Housel explains that your money story begins with your socioeconomic background. If you grew up poor, you might hoard money obsessively, even after achieving security. Your childhood scarcity created adult anxiety. If you grew up wealthy, you might spend carelessly because money always seemed abundant. If your parents fought about money constantly, you might avoid financial conversations entirely. The decade you experienced as a young adult particularly shapes investing behavior. Those who came of age during high inflation obsess about inflation forever. Those who experienced financial crisis become permanently risk-averse. Those who experienced roaring markets become permanently optimistic. We're all anchored to the economic environment of our formative years. This insight revolutionizes how you view financial advice. The financial advisor who lived through the 1970s inflation will recommend different strategies than one who started their career in the 1990s bull market. Neither is objectively correct. They're both shaped by their experiences. Understanding this prevents you from assuming your way is the only rational way. Housel emphasizes that recognizing your money story doesn't excuse poor financial decisions. It explains them. Once you understand that your fear of stocks comes from watching parents lose money, or your overspending comes from childhood deprivation, you can consciously choose different behaviors despite those ingrained instincts. The practical application is examining your own money story. What did you learn about money as a child? What significant financial events shaped your worldview? What messages did your parents communicate about wealth, spending, and saving? These experiences created biases you're probably not even aware of, but that drive every financial decision you make. Housel shares his own story. Growing up in Lake Tahoe, he was surrounded by extreme wealth inequality. Billionaires' vacation homes sat next to working-class, year-round residents. This created his fascination with the question, how much money do you need to be happy? Different than someone who grew up in a uniform middle-class suburb where everyone seemed similar economically. The key insight is that personal finance is more personal than finance. Your perfect financial plan is shaped by your psychology, your experiences, your goals, and your fears. Stop judging others' money decisions and stop assuming everyone should do what you do. Their story is different from yours, creating different rational responses. The action step. Write your money autobiography. When did you first become aware of money? What did your parents teach you about it? What significant financial events shaped your thinking? What are you afraid of financially? This self-awareness is the foundation for making financial decisions that align with who you actually are, not who financial experts think you should be. Chapter 2. Luck and Risk. They're both real and both ignored. Housel's second lesson tackles what makes people most uncomfortable. Luck plays a massive role in financial outcomes, and so does risk. The line between bold decisions that make you a genius and reckless decisions that destroy you is often just luck. He tells two stories. Bill Gates attended one of the only high schools in the world with a computer in 1968, allowing him to start programming as a teenager. Gates had extraordinary skill, but also extraordinary luck to attend that specific school. His classmate, Kent Evans, was equally talented and ambitious, but died in a mountaineering accident before they could start Microsoft together. Gates got luck. Evans got risk. The point isn't diminishing anyone's achievements. It's recognizing that success and failure both have components beyond individual control. For every successful entrepreneur, there are others with equal skill who failed because of bad timing, economic conditions, health problems, or pure randomness. For every failed business, there are others that succeeded despite worse execution simply because luck was on their side. Housel explains that we consistently underestimate luck's role when evaluating success, including our own. When we succeed, we attribute it to skill, hard work, and smart decisions. When others succeed, we sometimes do the same, creating an illusion that success is purely merit-based. This creates two dangerous beliefs. First, that following successful people's advice guarantees your success, and second, that failure indicates personal inadequacy. The risk side is equally important. Taking risks sometimes works spectacularly and sometimes fails catastrophically, often for reasons beyond your control. The person who risked everything on a business that succeeded looks like a genius. The person who risked everything on a similar business that failed looks like a fool. Often, the difference was pure chance, market timing, random events, or unpredictable circumstances. He shares the example of real estate investors who bought properties in 2002 to 2006. Those who happened to sell in 2006 to 2007 looked brilliant. Those who held through 2008 to 2009 faced foreclosure. Same strategy, same market, only timing differentiated success from ruin. The sellers weren't necessarily smarter, they were luckier. Housel's crucial insight when judging financial success or failure, yours or others. Be careful about attributing outcomes entirely to decisions. Some outcomes are luck, some are risk. Disentangling them is nearly impossible. This should create humility. When you succeed, recognize that luck probably helped. When you fail, recognize that risk might have played a role beyond your control. The practical implications are profound. First, never risk so much that bad luck can ruin you. Having skill doesn't protect you from random catastrophe. Second, learn from successful people's behaviors and patterns, but don't assume copying their exact decisions will produce identical results. They succeeded during specific circumstances with specific luck that won't repeat. Third, be less judgmental of financial failures, including your own. Someone who went bankrupt might have made reasonable decisions that got hit by bad luck. Someone who succeeded wildly might have made risky decisions that happened to work. The outcome doesn't always indicate decision quality. Housel also addresses how this should affect taking advice. When someone says, "I did X and became wealthy," ask what role timing, circumstances, and luck played. Often, the speaker can't disentangle their skill from their luck. This doesn't mean ignore advice, but be skeptical of anyone who claims their success is purely merit-based or that their specific path is a guaranteed formula. The humility this lesson creates is valuable. When you're succeeding, stay humble. Luck helped. When you're struggling, stay hopeful. Bad luck isn't permanent. When evaluating strategies, focus on sound principles rather than specific outcomes, because outcomes are too contaminated by luck and risk to be reliable guides. The action step. Review your financial successes and failures. For each, honestly assess what was skill and what was luck or risk. This isn't about diminishing accomplishments. It's about realistic assessment. When you recognize luck's role in past success, you become more cautious. When you recognize risk's role in past failures, you become more willing to try again. Chapter 3. Never enough When rich people do crazy things. Housel's third lesson examines why smart, successful people make catastrophically bad financial decisions. They don't know when enough is enough. The hardest financial skill is stopping the goalpost from moving. You think earning $100,000 will make you happy? You get there and immediately want $200,000. The goalpost keeps moving until you risk everything you have for more you don't need. He tells the story of Rajat Gupta, who earned $100+ million as a Goldman Sachs board member and McKinsey's CEO, upper echelon wealth. But he wanted more. He engaged in insider trading to make a few more million, got caught, lost everything, wealth, reputation, freedom. He went to prison because enough wasn't enough. Bernie Madoff is another example. Before his Ponzi scheme, Madoff was legitimately wealthy, running a successful trading firm. But that success wasn't enough. He wanted to be wealthier, more prestigious, more respected. The Ponzi scheme eventually destroyed him, his family, and thousands of investors. A man with genuine wealth chose catastrophic risk, chasing more. Housel's insight: the never-enough trap catches successful people more than unsuccessful ones. When you have nothing, risking it feels necessary. When you have enough to be comfortable forever, risking it is insane. Yet, people do it constantly. Why? Because comparison and social benchmarking make enough impossible to identify. The problem is relative comparison. You don't compare your wealth to average people. You compare to your peer group. If you're worth $10 million and your friends are worth $50 million, you feel poor despite being objectively wealthy. So you take aggressive risks to catch up. This destroys more wealth and market crashes. Housel identifies the core psychological trap. The ceiling of social comparison is so high that no amount of money is enough. There's always someone richer, someone with a bigger house, a nicer car, a more impressive net worth. If your measure of success is beating them, you'll never stop, never feel satisfied, and eventually risk too much trying to get ahead. He contrasts this with people who define enough based on internal standards rather than external comparisons. They decide what lifestyle they want, calculate what that costs, earn, save enough to fund it, then stop taking unnecessary risks. They might have less than peers, but they're happy because they're not trapped in infinite comparison loops. The hard truth Housel delivers: the only way to know when enough is deciding in advance. Write down, when I have X dollars, I will stop taking big risks. When my net worth reaches Y dollars, I'll shift to preservation. When my income hits Z dollars, I won't chase more at the expense of time and health. Without predetermined limits, you'll chase forever. He shares research showing that happiness for money plateaus around $75,000 to $100,000 annually for most people. Beyond that, additional income produces minimal additional happiness. But people earning $500,000 are just as stressed as those earning $75,000. They've increased spending to match income, maintaining constant financial pressure despite 5 to 7 times more money. The lesson extends beyond money. Never enough affects time too. Successful people work insane hours building wealth, telling themselves they'll slow down after hitting the next milestone. The milestone comes and goes. They keep grinding. Eventually they've sacrificed health, relationships, and years of life they can't recover for money they'll never spend. Housel emphasizes that this isn't about lacking ambition or being complacent. It's about maintaining perspective. Ambition to build wealth is good. Ambition that makes you risk everything you have for marginal gains you don't need is destructive. The difference is knowing enough when you see it. The action step: define your enough right now. What annual income would genuinely satisfy you? What net worth would provide security and freedom? What lifestyle do you actually want, not what would impress others? Write these down. When you hit them, defend them against moving goalposts. The person who knows when enough is richer than the person with unlimited money, but no satisfaction. Chapter 4. Confounding Compounding: Why Wealth Takes Time. Housel's fourth lesson is that compounding is both the most powerful force in finance and the most misunderstood. Everyone knows compound interest matters. Almost nobody grasps how completely time dominates returns in wealth building. Good returns for a long time beat great returns for a short time, every single time. His most powerful example, Warren Buffett's 100+ billion net worth, isn't because he's the best investor ever. He's very good, but not dramatically better than many others. His secret is that he's been a good investor for 80+ years. He started at age 10. He's 93. If Buffett had started at 30, even with identical returns, he'd have perhaps $10 billion, still wealthy, but 90% less than his actual wealth. Time did more work than skill. The math is simple, but shocking. $10,000 invested at 10% annual returns becomes $17,000 in 5 years, $67,000 in 20 years, $452,000 in 40 years, and $3.2 million in 40 years, 60 years. Same return rate, wildly different outcomes based purely on time. The difference between 20 years and 40 years is 7 times more wealth. The difference between 40 and 60 years is 7 times more again. Housel explains why our brains can't grasp this intuitively. Compounding isn't intuitive, it's exponential, and humans think linearly. We see 10% annual returns and think, okay, in 10 years, I'll have made 100% total. Wrong. In 10 years, at 10%, you've made 159%. In 20 years, you've made 573%. In 30 years, 1,645%. The curve gets steeper, not flat. This creates the psychological trap of impatience. People expect to get rich quickly and get discouraged when wealth builds slowly initially. Someone invests $500 monthly for 5 years and has $38,000. They've contributed $30,000, so they only made $8,000. It feels like nothing. They quit. If they'd continued 20 more years, that same $500 monthly would have grown to $380,000. They quit right before compounding accelerated. Housel shares the crucial insight. Compounding's greatest returns come late. The first decade of investing feels like you're getting nowhere. The second decade feels better. The third and fourth decades are where wealth explodes. But you only reach decades 3 and 4 by surviving decades 1 and 2 without quitting. Most people quit too early. This explains why starting early matters overwhelmingly. Starting at 25 versus 35, doesn't just give you 10 more years of returns. It gives you 10 years of compounding on those early contributions that grow for 40 years instead of 30. Those early dollars compound longer and become disproportionately valuable. He addresses the common mistake of trying to beat the market to accelerate wealth. People think 7% returns are too slow. I need 15% to get rich faster. So they take excessive risks, try timing markets, or chase hot investments. They often end up with 3% returns or losses because risky strategies backfire. They would have been better off accepting 7% and letting time do the work. The paradox is that the best investors aren't those who make the highest returns. They're those who make good returns consistently without blowing up. A consistent 8% return for 40 years absolutely destroys an inconsistent strategy that returns 20% some years and minus 15% others. Consistency and time beat brilliance every time. Housel also explains why the final years matter so much. Someone investing $500 monthly for 40 years at 8% accumulates $1.4 million. In year 30, their balance might be $680,000. The final 10 years added $720,000, more than the first 30 years combined. But you only get those magical final years by persevering through all the early years when progress feels slow. The practical lesson is that wealth building requires patience at a level that feels unreasonable. You must invest for decades, watch markets crash and recover, resist constantly chasing better returns, and trust that time will do work you can't do yourself. There's no shortcut. You can't compress decades of compounding into years. Accept this, and you'll build wealth. Fight it, and you'll fail. The action step. Calculate your wealth at age 65 if you invest consistently from now until then. Use realistic 7 to 8% return assumptions. The number is probably much larger than you expect. That's compounding. But you only get there by starting now and never stopping. Every year you wait costs exponentially more than you think. Start today, invest consistently, and let time do the heavy lifting. Chapter 5. Getting Wealthy versus Staying Wealthy. Housel's fifth lesson is that getting wealthy and staying wealthy require opposite behaviors. Getting wealthy requires taking risks, being optimistic, and putting yourself out there. Staying wealthy requires humility, frugality, and paranoia about losing what you built. Most people can do one or the other. Few can do both. He explains that getting rich requires taking concentrated risks. The entrepreneur who risked everything on a business, the investor who made concentrated bets on companies they believed in, the professional who took career risks pursuing high-upside opportunities. These behaviors can create wealth, but they can also destroy it if continued too long. Staying wealthy requires the opposite mindset, survival above all else, diversifying away from concentrated positions, maintaining cash reserves, avoiding risks that could eliminate you, planning for bad outcomes. The same aggressive risks that built wealth will eventually destroy it if you never shift to preservation mode. Housel shares the example of Jesse Livermore, one of history's greatest traders. He made $100 million in the 1929 crash, worth billions today. But he kept taking massive risks, lost everything, and died by suicide bankrupt. He was brilliant at getting wealthy. He failed completely at staying wealthy because he couldn't change his behavior. The psychological challenge is that the behaviors that made you successful are addictive. If aggressive risk-taking made you wealthy, your brain associates risk with reward. Shifting to conservative preservation feels wrong, boring, even cowardly. But that shift is essential. Many lottery winners go broke because they keep the spending behavior that preceded their windfall. Housel identifies specific mindset shifts required. First, accepting that good enough is better than best. Trying to maximize every return often leads to excessive risk. Settling for pretty good returns consistently keeps you wealthy. Second, survival is paramount. A strategy with 95% success rate sounds great, until you realize the 5% failure eliminates you completely. Better to earn less, but guarantee survival. Third, frugality is essential for staying wealthy. Many wealthy people maintain modest lifestyles, not from cheapness, but from understanding that lifestyle inflation is a trap. If spending rises with income, you never feel wealthier. You just have more expensive problems. Keep spending stable while wealth grows, and you actually feel rich. He introduces the concept of room for error, always having more than you need. If you calculate you need $1 million to retire, aim for $1.5 million. If you need $5,000 monthly, earn $7,000. This cushion protects against unexpected problems and bad luck. Those who aim for exactly enough often fall short because life doesn't cooperate perfectly with plans. Housel emphasizes that room for error is the difference between those who stay wealthy and those who lose it. Markets drop unexpectedly. Jobs end. Health fails. Businesses struggle. Those with cushions survive and recover. Those living at their limits get eliminated by normal bad luck. He also addresses the psychological benefit of room for error. It reduces stress. If you need every dollar and every investment to work perfectly, you're constantly anxious. If you have substantial margin, you can handle setbacks calmly. This calm leads to better decisions, which increases probability of staying wealthy. The practical application requires intentionally shifting behavior after achieving wealth. If you built wealth through entrepreneurship, transition some assets to stable investments. If you accumulated wealth through aggressive investing, diversify into safer assets. If you saved aggressively, maintain that frugality even as income grows. The behaviors that got you here won't keep you here. The action step. Assess where you are on the wealth journey. Are you still building, or have you achieved enough that preservation matters? If you're still building, continue taking intelligent risks. If you've achieved substantial wealth, start shifting toward preservation. Calculate your room for error. How much cushion do you have if things go wrong? If it's not substantial, building that cushion should be your next priority. Chapter 6. Tails, you win. A few big wins matter. Most Housel's sixth lesson reveals that long-term success is driven by a small number of events, a few enormous wins that overwhelm everything else. Most investments don't work. Most businesses fail. Most career bets don't pay off. But the few that work make up for all the failures, and then some. This is the tail event principle. A small number of outcomes account for the majority of results. He shares that, among venture capital investments, roughly 50% fail completely. Another 40% break even or deliver mediocre returns. Just 10% produce extraordinary returns. And within that 10%, a tiny fraction become the Google or Facebook investments that return 1,000 times plus and make the entire fund profitable. Venture capitalists know this. They expect most investments to fail. They only need one monster success. The same pattern appears everywhere. Among Warren Buffett's hundreds of investments over decades, a handful, Coca-Cola, American Express, Apple, generated most of his wealth. The rest ranged from mediocre to failed. But it doesn't matter. The enormous winners overwhelmed everything else. This is how compounding works in real life: lumpy, unpredictable, and concentrated in rare outcomes. Housel explains why this matters for normal investors. You can be wrong most of the time and still do phenomenally well if you're right occasionally on big things. The stock market is the same. The best performing 4% of stocks account for all market gains over time. The other 96% collectively break even. Picking stocks is hard because you need to find the 4%. But if you own the whole market through index funds, you guarantee owning the winners. This creates the crucial lesson. Don't judge your strategy by short-term results or individual outcomes. Judge by long-term portfolio performance. You'll make many investments that fail or disappoint. That's normal. What matters is whether the winners outweigh the losers over time. If you invest in 100 stocks and 80 are mediocre, but 20 do incredibly well, you'll be very wealthy, despite failing 80% of the time. The psychological challenge is that we hate being wrong. Every failed investment feels like personal failure. But in a world driven by tail events, being wrong frequently is the cost of being right occasionally on something big. Venture capitalists don't beat themselves up over failures. They know failures are the necessary price of finding the rare winners. Housel emphasizes that this principle should change how you think about taking chances. In careers, relationships, business, and investing, a few big successes can make up for many failures. This means you should take more swings, not fewer. The person who tries 50 things and fails at 45, but succeeds at 5 likely, does better than the person who tries 5 things and succeeds at 4. The practical application is maintaining diversification and staying invested through failures. If you own 30 stocks and 10 fail, don't panic. That's expected. If your total portfolio grows because the winners outweigh losers, you're succeeding. If you start 5 businesses and 3 fail, you're not necessarily doing wrong. Evaluate based on total outcome, not individual results. The action step: review your investing or business attempts. Are you expecting everything to work? That's unrealistic and leads to quitting, except that most attempts will fail or disappoint. What matters is whether your total outcomes, accounting for both wins and losses, trend positive. This mindset allows taking chances that feel risky but are statistically smart. Chapter 7. Freedom, the highest dividend money pays. Housel's 7th lesson is that money's greatest intrinsic value is giving you control over your time. Not fancy cars or big houses. Those are fine, but not the point. The highest dividend money pays is the ability to wake up every morning and say, I can do whatever I want today. That freedom is the actual goal of wealth building. He shares research showing that people who feel control over their time are happier than those who don't, regardless of income. An average earner who controls their schedule is often happier than a high earner whose schedule is dictated by others. The wealthy person chained to their business is objectively rich, but subjectively poor. If they have no freedom, this reframes wealth building entirely. The goal isn't accumulating the largest net worth possible. The goal is accumulating enough to control your time. For some people, that's $500,000. For others, it's $5 million. The number matters less than reaching the point where you choose how to spend your days rather than others choosing for you. Housel explains that this principle reveals why some wealthy people are miserable while some modest earners are content. The wealthy person who can't leave their business, who's constantly stressed, who can't take vacations, who sleeps badly worrying about money, they're not experiencing wealth's primary benefit. The teacher who works 9 months yearly with summers off and manageable stress might have more freedom despite far less money. The psychological insight is that we often sacrifice freedom to accumulate money, planning to eventually buy freedom back. But this trade often doesn't work. You sacrifice your 30s, working 80-hour weeks to build wealth. By your 50s, you have money, but your health is compromised. Your relationships are damaged, and you've lost decades you can't recover. You sold freedom to buy money, planning to buy freedom back later. But freedom purchased later isn't the same freedom you sold earlier. He introduces the concept of independence as the ultimate form of wealth. Independence means your financial obligations are manageable enough that you're not forced to do things you don't want to do. You can turn down work you find soul-crushing. You can leave toxic situations. You can take risks on opportunities that might not work but align with your values. Money that provides independence is well used. Money that increases obligations is counterproductive. Housel also addresses the lifestyle trap that destroys freedom. As income rises, spending rises proportionally. The person earning $200,000 but spending $195,000 has less freedom than someone earning $60,000 but spending $45,000. The higher earner needs that income desperately because obligations are massive. The modest earner has options because obligations are manageable. This connects to the never enough lesson from Chapter 3. People increase spending as income rises, maintaining constant financial pressure. They're always one job loss from crisis despite high income. They're trapped in jobs they hate because quitting would mean immediate financial catastrophe. They've built golden handcuffs with their lifestyle inflation. The practical application is ruthlessly protecting freedom as you build wealth. Don't increase spending proportionally with income. When you get a raise, bank most of it rather than upgrading lifestyle. When you evaluate jobs or opportunities, consider the freedom implications, not just the money. A lower-paying job with great work-life balance might provide more actual wealth than a higher-paying job that consumes your life. Housel shares his personal approach. He and his wife decided what lifestyle they wanted, calculated its cost, earned enough to fund it comfortably, then prioritized freedom over additional income. When offered opportunities that would increase income but decrease freedom, they declined. This intentional capping of both lifestyle and work intensity created the freedom they actually wanted. The action step: calculate your freedom number, the amount of savings or passive income needed to make work optional. Then calculate what lifestyle you actually want versus what lifestyle you think you should want. Often, the gap between these numbers is massive. you might need far less than you think to fund the life you actually want. Closing that gap quickly should be your primary financial goal because it delivers freedom, money's highest dividend. Chapter 8. Man in the Car Paradox. No one cares about your stuff. Housel's final lesson is perhaps his most psychologically devastating. No one is as impressed by your possessions as you think they are. When you see someone driving a Ferrari, you rarely think, wow, that person is so cool. You think, wow, if I had a Ferrari, people would think I'm cool. The irony is complete. The Ferrari owner bought it to impress you, but seeing it just makes you want one to impress others. No one is actually impressed. He calls this the man in the car paradox. You might think people who see you in an expensive car will admire you. In reality, they don't think about you at all. They're thinking about themselves in that car. This applies to everything: houses, watches, clothes, vacations, gadgets. People aren't thinking about you when they see your stuff. They're thinking about how they'd feel having that stuff themselves. The insight demolishes much of consumer culture. We buy expensive things primarily to signal success and gain admiration. But the signal doesn't work the way we think. People don't admire you. They feel envy, competition, or they're simply indifferent. The validation you're seeking doesn't materialize. You've spent enormous money to impress people who aren't impressed. Housel explains that genuine respect and admiration come from traits money can't buy: integrity, kindness, humility, intelligence, talent. The person driving a beat-up car but known for character and competence is more respected than the person in a Lamborghini known for nothing else. Money can buy things. It can't buy respect. This principle should fundamentally change spending behavior. If you're honest, much discretionary spending aims to impress others or signal status. The luxury car that costs $1,500 monthly, more than a reliable used car. The house that's bigger than you need because of how it looks to others. The clothes, watches, and gadgets purchased for their brand signaling. Most of this spending buys nothing of actual value. Housel suggests a thought experiment. Imagine you're the only person on Earth. What would you own? How would you spend money? Stripped of all social signaling, what actually improves your life? The answers often differ dramatically from current spending. That gap represents money wasted trying to impress people who aren't impressed. The financial impact of eliminating signaling spending is enormous. Someone earning $100,000 who spends $30,000 annually on status signaling could instead invest that money. Over 30 years at 8% returns, that's $3.4 million. They traded real wealth for fake admiration. When framed this way, the trade-off is absurd. The action step: audit your spending for status signaling. What are you buying primarily to impress others or signal success? Be ruthlessly honest. Then ask, if you eliminated that spending, would your actual quality of life decrease? Often, the answer is no. The spending was pure signaling. Redirect that money to freedom-building investments instead. Real wealth is having freedom, not having things other people don't care about. There you have it. 8 timeless psychological lessons about wealth from Morgan Housel's masterpiece that's transformed how millions think about money. Your unique money story shapes all your behaviors. Luck and risk play massive roles you can't control. The never-enough trap destroys wealthy people constantly. Compounding requires time more than brilliant returns. Getting wealthy requires different behaviors than staying wealthy. A few enormous wins matter more than being right most of the time. Freedom is money's highest dividend, not stuff. And nobody cares about your possessions as much as you think they do. What makes the psychology of money revolutionary is recognizing that finance isn't about spreadsheets and math. It's about human behavior, emotions, and psychology. You can know exactly what to do financially and still fail because you can't control your behavior. You can be average intelligence, but master psychology and become wealthy. Behavior beats knowledge every time. The most important insight from this book: financial success has little to do with how smart you are and everything to do with how you behave. Are you patient enough to let compounding work? Are you humble enough to know when enough is enough? Are you disciplined enough to avoid status signaling spending? Are you wise enough to prioritize freedom over more money? These behavioral questions determine outcomes far more than investment selection ever will. Your action plan: first, write your money autobiography to understand your psychological programming. Second, define your enough right now to prevent moving goalposts. Third, commit to consistent long-term investing and let time do the heavy lifting. Fourth, calculate your freedom number and build toward it relentlessly. Fifth, audit spending for status signaling and eliminate it. These 5 actions, driven by psychological insights, will transform your financial life more than any investment strategy. Remember, Housel's core message: doing well with money isn't about what you know. It's about how you behave. And how you behave is driven by psychology, not intelligence. Master your psychology and wealth follows. Ignore psychology and knowledge alone guarantees nothing. Thanks for watching this deep dive into the psychology of money. If these lessons shifted how you think about wealth, hit that like button and subscribe for more videos.